Hey everybody, it's Deanne with Realty One Group, and welcome to my Home Buying 101 series. If you've been following the series, you know that I've been talking about things such as credit reports, credit scores. I shared that financing is a really big part of the home buying process because unless you are paying with cash, you're going to need financing to buy that home. So I've broken down the financing videos into 3 different videos. The first one was around pre-qualifications versus pre-approvals. And then today's video, the second one, is going to be around the most common home loan options. And I thought I would do something a little different this time. And I would actually have some slides, as I understand that some of this information can get pretty detailed. So I want to make sure that you can have it for reference in the event that you need it later on. Or you're also welcome to watch the video from the beginning and just watch it again and again. If you find these videos valuable, if you think that it's helpful to other people, definitely subscribe and share. And then just like my first video, I will make sure to have some lender contacts in my description below so you can reach out to them for more specific information and loan options at their specific companies. The information that I provide is more of an overview, and then you can dig deeper with these with the lenders that are in the descriptions below. So Home Buying 101, we're talking about the second financing video and its most common loan options. So what you're going to see in the housing market in terms of mortgage options, the most common loan types are FHA loans, VA loans, conventional loans, and USDA loans. Now, I know that there's a lot of acronyms there, and we're going to be explaining what those different acronyms are, but those are the most common loan types that you're going to find as it relates to being a first-time home buyer, or maybe somebody that's buying a second home, or even somebody who is going from one home that you are selling and then going to buy another home in the process. So those are the most common loan types. In addition to those common loan types, within those major categories, you'll also find that these loans have fixed rates, as well as some of these loans can have adjustable rates. Fixed rate is, as the terminology implies, it's going to be a fixed interest rate throughout the whole entire life of the loan. Whereas an adjustable rate loan or an adjustable rate mortgage, these are loans where there's going to be a set number of years where it's going to be a fixed interest rate. And then after that, then the interest rate can change. It can go up or down based upon the current market environment and what's going on. Some typical adjustable rate mortgages, they are known as ARMs for short, but you might see one that is a 3-year ARM. You may see one as a 5-year ARM or a 7-year ARM. Back in the day when I used to live in the Metro Atlanta area, my husband and I had actually done a adjustable rate mortgage for that particular home. We were in a situation where we had just moved, and the income that was being used to buy that home was my income, and my husband had not obtained employment yet. So the adjustable rate mortgage was something that was great for us because it allowed us to get in at a little bit lower interest rate, and then when we were able to later on have more income, then we were able to have a stronger background for the underwriting process with our income, where we could then refinance. So it's just some things to think about, but definitely talk to your lender, whatever lender that you end up choosing, so that you know what's the best option for you. As well as all of the different loan products. Those different loan products, they have what's called different debt to income related ratios. So that means that they're going to be looking at the front end, which is what the monthly mortgage is to your monthly income. Or, they're also going to be looking at the back end of it as well, meaning what is your total monthly debt to that monthly income ratio. So the monthly mortgage to monthly income ratio, they're just looking at your mortgage, maybe if you've got things escrowed and your private mortgage insurance. The back end, now they're looking at your total monthly debt. So what are your monthly payments as it relates to not just the housing, but what do you have in terms of any type of car payments? What do you have in terms of student loans or personal loans? So any loan that you've got to pay per month, credit card debt. So anything that you've got to pay per month that is longer than 10 months, they're going to be evaluating that as a part of your total monthly debt to income ratio. Now, I talked about the acronym FHA. So FHA stands for the Federal Housing Administration. And this type of loan has a variety of different benefits. It is a government insured loan. And what that means is that the government doesn't actually, lend the loan out to you, but they have approved lenders that they work with, and they insure the loan with those lenders so that it encourages the lenders to help finance the home for you. Low down payments. So if you don't have a lot of money for a down payment, then this is something that's a benefit. It's only 3.5% of the loan. And then the credit scores are a little bit more lenient. They allow gift money to be used for the down payment and closing costs. And they also allow the seller to contribute up to 6% of the loan towards closing costs. So there's definitely a variety of different benefits to it. Now, one of the drawbacks, however, is that there are some limits as it relates to how much of a loan that you can get. They may not come in as many different options. For example, when we talked about the fixed rates and the adjustable rate mortgages. So they may only, depending on the lender, they may only have a fixed rate loan, or the adjustable rate mortgages. Maybe they only have one other product or two other products as it relates to that. And then this is probably the biggest drawback, is the mortgage insurance premium. That is something that is required for the life of the loan. And that could be a good couple of $100 a month that you have to pay as a part of your monthly payment. So just definitely some things to think about, but there's also some benefits well. The Veterans Administration, that's where the VA part comes in, VA loans. And this is geared towards military members, as well as spouses of military members who were killed in the line of duty. One of the great benefits about this is that there's no down payment requirement. So you don't have to have a down payment, as well as a seller can contribute up to 4% of the loan towards the buyer closing costs. Now, there are some things that you need to know as well. Although there's no private mortgage insurance, there is a VA funding fee, and typically that's about 2.30% of the loan amount, but it does range between 1.4 and 3.6 depending on the lender. And technically, as of 2020, there is no loan limit. However, the lender can have a loan limit. So the VA loans, those are also government backed as well. So some drawbacks to it is that the closing costs cannot be included in the loan, whereas the FHA loan, there you are able to roll into the closing costs into the loan. With the VA loan, you can't. Also, there may be stricter requirements on home inspections and appraisals for these types of loans. And so if you're looking at a much older home, you may need to be aware of those kind of things because we want to make sure that it passes the home inspections and the appraisals. Now, conventional loans, back in the day, these types of loans used to require 20% down, but this has evolved, which is a great benefit to our home buyers today. Some lending institutions have down payments that vary from 3% to 5%. What you're going to see typically is the 5% in the industry, but as I shared, depending on the lender, they may have things as low as 3%. Something that's key to this type of loan is that it requires a strong credit score and credit history. This particular loan is not insured by any government entities, so it can be a little bit more challenging to obtain this kind of loan because it means that you've got to have a really strong background as it relates to your income and your credit. However, there are some pros to this as well. Private mortgage insurance, it is something that is required, but it's only required until the loan to value ratio is 80-20, meaning once you've got 20% equity in the house, then the PMI can go away, as well as it has a higher loan limit than an FHA loan, for example. So if this is something that you're buying a home that goes over the FHA loan limit, conventional loan may be something that is an option to you if you've got that good credit score and the proper down payment and so forth. The USDA loans, those are loans that are created, so to speak, for rural home buyers, and they're issued by approved lenders. So once again, the USDA is not, the government is not lending the money themselves. They are just guaranteeing or backing the loan so that other mortgage brokers, other banking institutions are encouraged to lend the money. One of the nice benefits about this particular loan is that it's for rural areas, and it can be up to 100% financing available. There's no limit to first-time home buyers, so that means that you could be maybe already own a home and getting a second home. It does require there to be a strong credit score and stable income, as well as, and this can be a drawback depending on where you're located, the home has to be in a USDA eligible location. So for those of you that are in the Savannah area, you're going to notice that you can't do that in Savannah. You're going to have to go out more to places like Guyton, Rankin, Fort Wentworth, maybe Richmond Hill. So definitely some things there to think about when you are trying to see if this is a possible option for you. Now, of course, with all of that, I keep talking about these different credit scores and whether or not they are important to that particular home option. So I thought I would provide for you some typical credit score ranges for loans. The common minimum credit score for loans for conventional are 620 or higher. There have been some lenders that go as low as 580, but definitely the most common is around 620 and higher. For an FHA loan, the most common that you might see there are around 580. VA loans, credit scores there range from 580 to 620. USDA loans, as I shared, are ones that do want the strong credit score, especially with it being 100% financing. And you'll see there that 640 is the most common. But as I shared, it's really, really based on the lender. These are the most common, and they probably don't veer too far away from it, but talk to the lender that you are interested in, and that way you'll know for sure. So I hope this information has been helpful. Once again, I'm BN with Realty One Group, and feel free to continue subscribing because the next video that I'm going to be doing around financing will be the overall mortgage process. Thank you so much for attending.